Bom dia a todos. Muito obrigado pela presença de vocês na terceira edição da nossa Global Managers Conference, o principal evento da área de distribuição de terceiros do BTG Pactual, onde nós reunimos os melhores gestores globais em lives preparadas para todos os nossos clientes. O tema do nosso último dia da conferência será ESG, remodelando o mundo de investimentos. Para esse painel, nós convidamos a NN Investment Partners, Paul Schofield, Head Sustainable Impact Equity. A NN é uma gestora de ativos com sede na Holanda e escritórios em 15 países da Europa, Ásia e Américas. A gestora gere 287 bilhões de euros em ativos para clientes, integrando critérios ambientais, sociais e governança corporativa, ESG, ao longo do processo de investimento para a maioria das suas estratégias. A NN Investment Partners oferece serviços para fundos de pensão, seguradoras, family offices, consultores financeiros independentes, bancos e pessoas físicas, além de gerir os ativos do grupo NN. E conosco teremos também a Robeco. Robeco é um grande parceiro nosso aqui nos investimentos internacionais. Representando a Robeco, teremos a Masja Zandbergen, Head of ESG da Robeco. Robeco é uma gestora de ativos também sediada na Holanda, em Roterdã, que oferece ampla gama de estratégias e investimentos em ações, renda fixas e alternativos. Como eu disse, fundada em Roterdã em 1929, a Robeco acredita fortemente nos investimentos em sustentabilidade, técnicas quantitativas e inovação constante. A gestora possui hoje mais de 170 bilhões de euros sob gestão. E para moderar esse painel, convidamos a Mariana Oiticica, Head de ESG do BTG Pactual. Muito obrigado a todos e agora eu passo a palavra para a Mari. Obrigado, Mari.
Obrigada, Caio. So good morning to you all. Thank you for being here. It's a great pleasure to moderate this panel with representatives of two companies that are pioneers and models of sustainable investing. So I'll start with Masja. I would like to tell to our audience why we should invest in sustainable products, Masja.
Thank you, Mariana. Well, maybe we should ask, why should you not invest in sustainable products? I think investing sustainably is really a personal thing, but there are roughly two ways of looking at it and two reasons why you want to invest sustainably. And I think I'm a fan of both and a supporter of both. So the first one is that it gives you a more long-term investment view. And if you take material ESG issues into account in your investment process, I firmly believe that it will make you a better informed investor. And this view is also supported by research from Morningstar, and they have analyzed over 700 sustainable funds in Europe and compared them to almost 5,000 regular peers. And they looked at performance of the funds over 1, 3, 5, and 10-year investment horizons until the end of 2019. And they actually conclude that there is no performance trade-off associated with sustainable funds. In fact, they are saying that the majority of sustainable funds have outperformed their traditional peers over multiple time horizons. So the first reason to invest sustainably is that you just are a better informed investor. And then the second reason, I would like to call this the child effect. What would you rather explain to your kids or your grandkids, or maybe your nieces and nephews if you don't have kids? Would you like to tell them that you invest in companies that violate human rights or companies that create problems for them in their future? Or would you rather tell your kids that you're investing in companies that actually treat their employees and their societies very well and solve sustainability issues? So either avoiding doing harm or investing or engaging for sustainable solutions. Well, I think I would like to tell my kids the second. So that is also for me a very important reason why you should invest sustainably.
Thank you, Masja. Paul, and what ESG means to you and NN Partners?
Yeah, well, morning, everyone. Thanks very much for having me today. And I should say, on a personal note, my entire career has revolved around sustainable investing in one way or another. From the very first fund I was given to manage maybe 22 years ago, right through to the present day. So for me, this is just normal investment. Sure, the level of sophistication has increased over the years. I perhaps started with some negative screens, no tobacco, for example, before things started to evolve, move perhaps towards best in class, so perhaps positive screening as well as negative. And then things like best efforts or ESG momentum started to pop up and become interesting. And more recently, I guess there's been a closer focus on active stewardship. It's necessary now. Our clients expect that of us. And for some of the reasons that Masja has just mentioned. Now, I completely understand that in different parts of the world, we're on different paths when it comes to this journey. Europe, where we both live, started this early, and other parts of the world have taken a little bit more time to get comfortable, and that's fine. I suppose the only real surprise here is that we're not reinventing the investment wheel here, and that's what I wanted to sort of stress here. Perhaps as an industry, we haven't done a very good job in promoting or talking about all of this, and some people are therefore nervous or confused. But actually, I'm not doing anything special, and I've not done anything particularly special or different over the last 20 years. And let me explain that. Just first and foremost, I'm an investor. My day job is to take people's hard-earned money, savings, pension funds, whatever, and invest them in businesses that fulfill my investment philosophy. For the record, I like quality growth companies. That's just how we do things. That's not necessarily the only way to do things, but that's how we do things. I get measured, like every other portfolio manager, on whether my funds outperform an index, a mainstream index, in this case, not an SRI index, but just a normal equity benchmark, the MSCI World, for example. If I do that, then life is good. If I underperform, then like every other manager out there, I'm in a little bit of trouble. But just because I happen to be a sustainable fund manager, that doesn't mean I invest in a different way. I'm not doing anything particularly new. I try to analyze the fundamental investment case of the stock just like everyone else. I want the management of the companies that I'm thinking about investing in to manage every financially material risk that they might face, whatever that might be. And so if a business, I don't know, an energy company, for example, isn't managing any potential environmental risk that they might face, then I'm not going to be very impressed. If such a company suffers an environmental issue, an oil spill, for example, we've all read about these, then the level of fines they'll be hit with will be very financially material and will impact the share price. So I want these financially material risks to be managed well. If they're not, then I'm not going to be very comfortable. That's the same as just about every other investor out there. I perhaps have a little more of a focus on environmental issues, social issues, and perhaps corporate governance risks, but alongside everything else, certainly not instead of everything else. So it really is just a normal common sense way of investing for me. And I also agree with the comments that Masja made. It's just that why wouldn't you do it this way if you're doing everything else that a normal investor would do with just a little additional focus on the environment, for example. So that's kind of my view. And NNIP and Robeco, both of us, I think I can speak for both of us, we both firmly believe that financial returns and good ESG risk management go hand in hand. And so why wouldn't you? So it's a very long answer to a very short question. Sorry.
Yeah, you mentioned that in Europe you began earlier, and that's true. I mean, in Latin America we are far behind it, and there is an idea of our investors that when you do an investment in sustainable bonds or funds, you in a way are not you receive less returns. Can you elaborate a little bit more on that, both of you?
Would you like to start, Paul?
Okay, yeah. I mean, I will. I say it's a good point and a very good question, and it's the question probably as we go and sort of promote what we're doing. It's probably the question I get asked the most. Are you giving up returns if you manage money in this way? And you have to be a little bit careful when you answer that question. Back to the early days of my career, you're excluding certain sectors on perhaps ethical grounds, tobacco being one. And so potentially, if the tobacco sector outperformed, you were potentially handicapping yourself in allowing your clients to capture those returns. So you have to answer like that, particularly in the early days. But as we've got more and more comfortable with this, we've got a little better at it, we've got more experience at it, and the academics have been looking at the topic. I think the vast majority of academic work out there would suggest that either integrating ESG into your investment process either has a very positive impact or is positively correlated to financial returns, or it has no correlation with neither positive nor negative with financial returns. Probably about 2 to 3% of all academic research out there would suggest it's negative for returns. So really, and look at the track records of many of these ESG, SRI, sustainability funds. Really, we've now got 25 years of running money in this way, and you can simply see that these funds on average are beating their performance benchmarks. So, it really isn't, it's almost a case now of in Europe, you don't get asked that question anymore because it's almost a given that this is either neutral or positive, not negative. So sorry, Masja.
Yeah, no, I completely agree. I think I already mentioned in the beginning that Morningstar looked at over 700 sustainable funds, and they actually concluded over a period of 1, 3, 5, and 10 years even, that there's absolutely no trade-off between sustainability and investment returns. What I would like to say, and I think Paul already mentioned it earlier as well, it is still investing. So it's not, buying a data set of ESG data and then applying that to a portfolio and saying, okay, I have a sustainable portfolio. No, you really have to understand what you're doing. And in that respect, I think selecting the right manager is also very important because, you're not going to select a value manager that has just started last year with their value strategy. I think you should select managers that are capable of both providing financial and sustainable returns, and both, I believe, go hand in hand. And I think that has been proven already. But you need to select the right funds and the right managers. There's nothing different about sustainable investing in that way.
Thank you, Masja. So how do you integrate ESG investment processes? What are the lessons that you've learned on this integration? Can you talk to our audience about it?
Yeah. So let me just make it very clear. When I talk about ESG integration, I don't talk about excluding companies. I don't talk about a best-in-class approach. I really talk about using ESG information to make better informed investment decisions. So thinking about how do ESG issues and trends affect the way the companies that I invest in create value. And we actually have a 3-step approach. First, we think about what are the most material ESG issues for the company that I'm looking at. How is this company managing those issues? And is that giving them a competitive edge or a lower or a higher risk profile? And then I can think about, in the third way, I think about the impact on the business model and on maybe even the valuation, the value drivers. So when we look at what is material for a company, easy examples are, of course, climate for the energy sector, or health and safety and climate in the mining sector. But there are also a lot of other examples. For example, for the pharmaceutical sector, things like how do you price your products in the light of the rising cost of healthcare is a very important topic. What is the risk culture when you're looking at banks? Those are very important ESG topics that are very different for each company that you look at. And you need to have a good view on this, and you have to do research. And then you can analyze which company is doing better than other companies on those issues. And maybe that is giving them a competitive advantage. And if you've researched that, then you can take that into account in your fundamental analysis or in your valuation. And we really adjust the valuation according to our ESG analysis. And there are some lessons that we learned. I think it takes time to understand the issues. It takes knowledge, it takes training, and it takes experience. So you can't, you need to start doing it and then, working with the information, training your portfolio managers to understand how to use that information. And then the second lesson I think is important also to mention, ESG issues are not always relevant for every company that we invest in. So we always systematically analyze, but when we look at our equity universe, we find that in only roughly 50% of the companies that we look at, ESG is actually having an impact on the valuation. And when we look at our credit portfolios, so the corporate bonds, it's only 35%. So, ESG is not always relevant. And then what we also find is that our ESG analysis positively contributes to the performance of our funds. And I think that's also a lesson that we learned. So first we had the belief that it would help us, and now we have the data and the experience to also show that it actually helps us.
Yeah, and just to add on to that, and something you'll probably hear both of us say, we've already said it a few times, it's all about financial materiality of these ESG issues. If they're not financially material, we're not going to waste too much time looking at them. We're not, born tree huggers looking at every company in the same way. We don't want them to plant trees in their front garden just for the sake of it. That's not financially material. We only want them to focus on risks that could impact the share price over the longer term. And by doing that, I think you get a better view of a company, and you also get better companies to invest in, higher quality companies. So I think that's very, very, very clear for us and the lessons we've learned. I suppose not every company is the same. Again, just sort of echoing Masja's point, not every sector is the same. What is material from an ESG perspective for a sector over here is going to be very different to what's material for a sector over here. So you just need, as Masja has said, you need an understanding of what is material, what is financially material, and then focus on it and make sure your companies are managing those risks as best they can. And then, you could just combine that with fundamental research. You just do the same as every other asset manager. So it's an additional data set that we look at. We're investors. We're supposed to be interested in data. So if there's an additional data set that focuses on something that's financially material, why wouldn't we look at it? Makes no sense to me to ignore something that could be relevant. Let's bring it into the discussion. Let's bring it into the decision making and the modeling, let's say. And let's just incorporate that data in our thought process and our investment process. So fairly straightforward.
Thank you so much. So Paul, can you give us examples of ESG metrics and portfolio monitoring that you follow during the lifetime of your investments, and how NN differentiate from other players?
Yeah, it's a good question, and I think I'm English guy. I'm very skeptical. I question everything, and I think that's probably a good mindset to have within ESG. For our clients, for example, don't take the word of your investment manager that they're doing all this good stuff. Performance is very clear. You can see that, in the FT or whatever. But actually, the societal alpha, if you like, the good stuff, don't just take their word for it. Get them to prove it to you. Now, we need to be open and transparent, not just when things are good, but when they look less good. So that ability to prove to our clients has got easier over the years because it was predominantly based on or disclosure from corporates has been historically very poor. As we get closer and closer to this day and age, that disclosure has got a lot better. And therefore, being able to prove this sort of stuff to your clients is much easier than it was. There's no set standard for these clients to report. By and large, they don't have to report very many things this day and age. That's changing with regulation, but the situation has massively improved over recent years. So that's a start. The regulatory focus has skewed clearly towards environmental reporting, and it's now pretty easy to report some kind of carbon footprint of your fund versus a benchmark or versus something. It's now required in parts of Europe to do that. So environmental issues, carbon footprint, that sort of thing, pretty much every manager will be doing now. Other environmental topics, looking at waste, water intensity, that sort of thing, we like to do that to make sure that our funds are on the right path. Within governance, some metrics are quite easy to find. Board independence, board diversity are things that we like to track over time, not because it's simply the right thing to do, let's say on diversity. Again, back to what we said earlier, it can also be very financially material. Having a more diverse board is better for me as a minority shareholder than having a non-diverse board. So we need to carefully encourage diversity, particularly at the senior management level, but also throughout the business. If you don't measure this sort of thing, then you can't ever track your progress. And hence, even if the starting point doesn't look great, we like to publish it and have something to work on as we move through time. So we don't want to hide away from the bad stuff. And when I say the bad stuff, where it's been very difficult historically is on that social side, because disclosure is usually really poor in these areas. We like to track some health and safety type metrics, maybe fatalities at our businesses, maybe lost time incident rates, how often people are losing time away from their jobs because of illness or injury. And there's a growing number of things we can look at from an employee perspective to make sure that our employees and the companies that we invest in are happy and healthy. And again, having a happy and healthy and stable workforce is a more productive workforce. It means you don't have to rehire all the time. It means no big insurance policies when someone chops their arm off in the factory. All of these things are financially material. So if we have the data set out there that is good enough for us to use, then why wouldn't we do that? And let's go on that journey with our clients. If a particular metric doesn't look quite good at a single point in time, let's engage with the companies within the portfolio that have a particularly poor score on fatalities, for example, and let's try and engage with them and go on that journey with them to improve that metric. So there's a lot of things we measure. Mostly they're good, but on occasion they're not, and it's how you deal with that bad indicator that I think our clients really appreciate. Not great here, but actually over time we can show that we've changed corporate behavior, and that will come through in the figures. So that's kind of the sort of thing we're looking at. Data is much more readily available now, so this set of what we can report will get bigger and bigger over time, and the regulators will insist that we do publish some of this stuff and do make it more transparent. So we're trying to get ahead of the curve, and I think probably Masja would agree with that.
Yeah, I completely agree, Paul. Maybe one question for you. We talk about financial materiality, we talk about ESG integration. I think we're exactly on the same page there. My second reason that I mentioned earlier is also, what do you tell your kids, right? Are there any areas that you don't invest in? Because we at Robeco, we do have some exclusions, and I know it can be difficult if you're investing in one market, like Brazil. Then you have a very limited investment universe, so it will be very difficult to exclude companies from that. But yeah, we have a global investment universe, and we say there are certain areas of business that we just don't want to invest in because that just doesn't fit our, let's say, leadership in sustainability. And for me personally, it doesn't fit what I tell my children. So we don't invest in controversial weapons companies. We don't invest in tobacco. We don't invest in companies that have a lot of thermal coal exposure, and those are the areas where we say, okay, this is where we draw the line, and it's only a very small part of the universe, so we can easily do it without losing our ability to generate alpha. So I was wondering if that is also something that you do, or
yeah, absolutely. Yeah, it's very important for us, and I suppose it's where sometimes, when you're excluding certain stocks from your investable universe, some people don't like that. For example, some of the client base don't like you to reduce what you've got to invest in that pool of stocks. But I absolutely agree with you. Whereas this used to start perhaps as more just an ethical decision for our clients back in the day, maybe religious clients, for example, not wanting various elements in their funds. That's progressed over time, and yeah, we avoid similar situations to you. Things like the oil sands in Canada, for example. These are not very energy intensive ways of getting this oil out of the ground, and we prefer other ways if you're going to invest in an oil company. Thermal coal, you're absolutely right. Gambling, we don't agree with, particularly tobacco, alcohol, pornography, weapons as well. So there is a list that sounds quite long and quite daunting, but actually, to your point, when you add it all up together, it isn't a very significant portion of the market. Maybe, I don't know, depends how you measure it, but maybe somewhere between 5 and 10%, let's say, of the market. We would rather spend our time on the other 90 or 95% of the universe where there are good companies, and they are doing activities that we think should be supported. So you're absolutely right, that it's not every company we'd invest in. And I think the interesting bit there is, perhaps when I started, what our client base thought we should screen out might not necessarily be what our children think we're going to have to screen out of funds. My son is he's in bed now. Would you believe it's midday here in the UK? But he when I talk to him about investing in tobacco, his generation don't smoke. They don't really have a very strong negative opinion on tobacco, so it's really not forefront of his mind. Whereas my father absolutely wouldn't want us to invest in tobacco. My son would be concerned about the industrial keeping of animals, perhaps, or testing on animals, that sort of thing. So, we have to, as asset managers, be sure that we keep ahead of what our clients actually want, rather than impose these restrictions upon them. And that's another challenge altogether.
Super interesting. So, Masja, what do you believe are the main benefits for a company that integrates ESG?
Yeah, that is a difficult question, because sometimes, and this is also a dilemma, I get questions from our investment teams about, so what about a company that is in a very competitive marketplace and they have to invest to make their production process more clean, more healthy, better safety records, and then they have to maybe increase their price a little bit, because otherwise they lose their competitiveness, and then they lose competitiveness. And that's a difficult question, but I really believe that, and this is something that we're seeing that our investment teams are doing. They actually say, okay, this company is lagging in environmental investments. They need to invest more to make sure that their factories are in line with regulation, or increasing regulation on environment, on CO2 emissions. And then they forget to think about the benefits in the long run of doing that. And so if we are going to get a tax on CO2, or if regulation is becoming even more strict in the future, the companies that are already prepared for that, they will get the benefit in the future. So sometimes investment specialists tend to forget about the benefits that these things are going to bring in the future. And I think if a company is prepared, it's just future-proofing your business, making sure that you're prepared. You always have to think about the next quarter and the next year. It's not that you forget about that, but you also have to think about making sure that in the next 5 to 10 years, your company is still doing well. And so it's combining that long-term view with the short-term, with managing the short-term business as well. And I think, that's going to help any business in the future. And I think an interesting example was in the Netherlands, where we had the CEO of our big food company in the Netherlands that said, I'm no longer going to produce quarterly reports, because I think it distracts our people in my business to think more long term. So they're always working on those quarterly numbers, making sure that they make them, that they beat them, and it's really hampering our ability to think longer term. And I think that was a very brave and a very good decision in terms of leadership. And this company has actually done really well. So that's an example of how it can help companies.
Yeah, and I'd only add on that. Actually, I absolutely agree. Sort of medium to long term, we have to think about these things and invest in the right way. But actually, in the short term, we're in a different society now to the one that I sort of grew up in, whereby people are very, very quick on social media or things like that to complain about companies, and that can massively distort the share price of a business if they get a bad customer service example, let's say, or if they're working in the office and they don't think the office is very safe, or people are not paid particularly well, they will complain about it now, whereas years ago they wouldn't. And so it's very visible. You can almost take a company down with some well-chosen words from a particularly influential person on Twitter, and that's short-term, therefore becomes quite challenging as well. Yeah. So really, short, medium, and long-term, this is really interesting.
Mm-hmm. Yeah, and also maybe to add to that, what we've seen is that, of course, in, let's say, 50 years ago, companies' market value was its book value. So what was on the balance sheet. Now, market values of companies are very much a lot of also intangible assets like brand, reputation, intellectual property. And these can specifically be affected by things that Paul was mentioning. And I think that's why also it has become much more relevant to think about these issues when you're investing in companies.
Okay, thank you. So Paul, can ESG momentum strategies generate alpha or impact financial returns? What's your view on that?
Yeah, I mean, that's a great question. Actually, I've been doing this a long time, and we've always carved out a portion of the portfolio for precisely that, really. So academic evidence would support it very clearly. My practical experience would kind of would sort of back it up. We invest in a portion of the fund, not all the fund, but a portion of the fund in companies that are perhaps not quite there yet at managing their material E, S, and G risks, but are, in our opinion, on the path to getting it. And in my experience, that portion of the funds tends to do more than its fair share of heavy lifting from an alpha perspective. And the thinking here is pretty clear, and in my opinion, down to the quality of the company. So let me kind of give you an example. Typically, with a company with good ESG risk management, that company will tend to trade at a premium to those similar companies with poor ESG risk management in the same area, in the same space. The market thinks that one is higher quality than the other, and if that market perception were to change, i.e. this low quality company starts to improve, you tend to get a re-rating in the marketplace, which is great for us as shareholders. So absolutely momentum is important. It's key for performance, but it's also key for having a positive impact on society. Back to Masja's point about doing the right thing and what you can tell your children. If we only invested in those companies that are good, then there's no incentive for the lower quality names who are perhaps a little behind in terms of managing these ESG risks. There's no incentive for them to improve at all. And so we need exposure to both. We need to invest in the good companies and reward them for doing their business in a really sensible way, but also invest in those companies who are determined to get their business to a better place. And if we can do that, and we help that with engaging with the company, we might help that with proxy voting, that sort of thing, that stewardship element of our job. But it's a very powerful alpha generator for funds like ours. So it's very important that we do it for an alpha perspective, but also that societal alpha that I've mentioned. So definitely the answer is yes.
And do you label those kind of investments as transition investments, or you do not do this kind of separation?
Yeah, we would refer to them as a basket of stocks within our fund that are almost best efforts, if you like. They're on that journey to improve, but not quite there yet. So it's a little harder as a portfolio manager to monitor these companies. You know, you've had dialogue with them. They've promised you that they're making the right steps to improve whatever's material for them. Let's say environmental risk, and you probably have a smaller active weight in these companies, because it's a little bit of a, as we would say here, a show me story. But we would have that dialogue with them over the longer term, and you would just monitor and measure that what they're saying they're doing is actually coming through. And as that happens, then the market just gets more positive and they re-rate. So best efforts, you could call them. We just call them our average bucket. They're average, but on the path to become next year's best in class, if you like. That's how we think about things. Harder work, more labor intensive, if you like, but really well worth that additional workload because of the alpha you can generate from them.
Masja, do you want to add something on this?
Yeah, I agree with that. We also engage a lot with companies for them to improve their business practices and thereby also improving the potential return. Because if you say, you know, we are integrating ESG and we think this company has a higher risk profile because it has some issues with corporate governance, for example, that will lead to a lower valuation. If you then still think it's interesting to invest in that company, you can, but then you can, by engaging, you can actually unlock that value and say, okay, now the risk profile and the company has improved on corporate governance. We can actually take the risk profile down, then the valuation goes up. So you can actually, so this company is actually more interesting to invest in then. So I think that's what we've been doing also already for over 15 years in terms of engaging with these companies. When we do research, because it's just an ESG score is such a slow moving score, we don't really find that having structural exposure to momentum in ESG is actually improving your returns a lot. The way a company is doing on ESG is the level and the score is still quite important compared to the momentum. But there, Paul and I think have a slightly different in opinion. So I think it's important to look where companies are now, and then also, of course, you can improve by engaging with them. But really, from a quantitative perspective, we don't have the evidence yet that it works.
Yeah, and I would, I mean, we can argue this all day long, but I think we're broadly on the same page, but with a slightly different experience of this situation. But for me, I think you could have a very good strategy of just owning these companies that are improving, But the downside of doing that, if you just had a basket of those or 100% of your fund in those, is you want to show a lower carbon footprint than the index. You want to show, you know, better health and safety metrics versus the index. And if you only buy the guys that are average but getting better, you're probably not yet going to be able to show that better carbon footprint than the index. They're not quite there yet. You would over time, but you wouldn't right now. So a combination of the two is what we found most powerful. And if you want to put numbers on it, 3/4 of our fund historically would be in the good guys, you know, the higher scoring, the higher level, and we carve out about 25% of the fund in that improving bucket. So I absolutely agree. You know, it's a good mix, I think, is what you kind of need, and you need to help with that engagement and that stewardship. You need to help these companies on that journey as well, and that can be very successful for you know, for alpha generation and clients ultimately.
Very interesting for us. So we've talked about why we should invest in sustainable products, how and what you achieve with that, but let's talk a little bit about the downsides of it. So Masja, is there any potential downside of integrating ESG or any particular risk that you see?
No, there's no downside, Mariana.
Short answer.
No, I'm just kidding. The worst thing I think that can happen is that everyone starts investing sustainably. Everyone starts doing that on the same data. We have a few big data providers that provide ESG scores. Everyone is using that. You're outsourcing your ESG work to someone else, and I think that is a downside. I think we should always, as investors, think for ourselves. So use the data and the ESG scores as a starting point, and then do your own research, do your own thinking. And so if we only rely on external data providers, I think that is a risk. And what happens then is that if we are wrong, in the end, we will end up with having no better world and also no better financial returns. So again, it comes down to selecting those that really understand, that really know how to apply, and that really have a track record in sustainable investing.
Yeah, I would echo the use of an off-the-shelf rating. I do find quite frustrating. I think it's quite important to have your own proprietary element to what you're doing, to control what you're seeing, what you're doing, what is material, because things can change in terms of materiality over time. So I would absolutely agree there. And actually, I think there's plenty of work out there now that looks at the correlation of these external ratings providers. You'd think a good company was a good company and they'd all rate the same companies really well and the bad companies really poorly. But actually, the correlation between these ratings is not very high at all. So even amongst the ESG community, they can't quite understand what works well and what works poorly from an ESG perspective. So some of the asset managers with that long history, you know, Robeco, NNIP, for example, having that process that's been in place for many years, having a well-staffed, team of responsible investment analysts plus portfolio managers who've kind of done this job for a long time is quite important. Because that experience really does pay dividends, I think, in terms of share price performance and just understanding this space. So it's quite important. I would say that a risk for me, or the potential downside, there's a couple in my mind that Masja hasn't mentioned, and it's a lot of, let's say, US technology companies, which we all know over the last 3, 4, 5 years have performed very, very well. From a corporate governance standpoint, from an ownership standpoint, or a minority shareholder standpoint, these are owned typically by and large by the founder, and they would have, in cases of Alphabet, in cases of Facebook, in cases of Amazon, they would have pretty much the voting power for that company, and that. When you look at a governance score for a company, probably means that governance score is going to be a lot lower, and these companies are therefore probably, total score is a little bit lower. So that could leave you to missing out on some of these businesses if you're not careful, if you just go by a static score. So we need to then look at the track record of the owner. Is he in it for the right reasons? Has he got a track record of generating returns above the cost of capital over the cycle and growing those returns? And if the answer is yes, you can get yourself a little bit more comfortable with a low governance score, for example. So it's not the score. Scoring alone is not enough. That's the quant measure. You need to do a bit of qualitative work over and above that until you're sort of more comfortable. So I think that's a downside. If you don't do that properly, you'll miss some great businesses that just happen to be owned by the founder still, who has most of the voting power, and you've got to get comfortable with that. But doesn't mean it's a bad business necessarily. Sorry.
Yeah, if I can add, I mean, that is the issue. It's never black and white. It's always gray. So look at the tech companies. In 2015, we started engaging on data privacy. We actually increased the risk, the weighted average cost of capital for some of those companies, very interesting companies to invest in. And we remained invested, but we knew that this might become an issue in the future. And that's why we applied a higher risk to that. And that's why we engage with companies also to gain more insights. So it's never black and white. It can still be the case that you see an issue, you take it into account, but you still want to invest in those companies. I completely agree with that.
And the other element I just pull back on or raise a slight cautionary note if we're going to do that. I've mentioned that I associate sort of ESG risk management with quality. And I think most of the ESG global funds, let's say, out there would have that tilt towards quality. And that, I think, is something that I would fully support. I think that will outperform over the longer term. But of course, there are moments in the market whereby the market doesn't like quality, and we've just come through a little period of that, actually, where the market's, gone to cyclical, gone down the quality curve. And so sometimes, your bias, if you like, towards higher quality companies can go against you if the market is feeling that way. Historically, they tend to be quite powerful, actually quite brutal in terms of movement, but quite short-lived. And so, you just have to take that on board. Just know that probably you're going to have a tilt towards quality that doesn't outperform in all markets. It outperforms in most markets, but not all markets. So important for clients to remember that.
Thank you, Paul. You already mentioned that, but I would like you to explore a little bit more. In what sense are ESG consideration not financial? And are they considered more qualitative? You already mentioned that, but I would like you to explore a little bit more.
Yeah, I mean, it's a good question. I would say ESG considerations are not always directly financial. For example, and I touched on it already, employing a diverse management team or diverse workforce will not be directly evident on financial statements. Let's put it that way. But a diverse workforce can bring you a wide range of benefits, such as better understanding of customers or enriched idea generation, and they can yield further down the line financial benefits. So you're not going to find it as an item on the balance sheet, if you like. Another example would be a policy for something like bribery and corruption. Now, assessment of these policies requires some qualitative judgment and cannot directly be found in a line item of a financial model on the sell side or on our analysts or Robeco analysts, but they can very much and very significantly inform the risk assessment of a potential investment. So you won't see it directly financial, but actually, if you think about it, take one step back, it will have some financial implication further down the line. So that's the distinction I would make, if that makes some sense.
Thank you. Maj, I would like to change a little bit about to explore a little bit how we should build climate resilient portfolios. This is something that certain investors approach us to explore this subject. So I would like to see your view on that.
Yeah. Climate is the most talked about and the most biggest topic that we receive questions on from our clients currently. And we also did some research across 300 investors globally, both wholesale and wholesale and institutional. And in 2 years' time, 88%, that's almost 90% of all of those investors believe that climate will be either an important factor or it will be central to their investment strategies. And climate is a systemic risk. It's not that we can protect all of our portfolios against climate risk, because transition is something that you can take into account, but physical risks of flooding and is very difficult to predict. So it's a systemic risk. So I'm happy that 88% is saying that they are going to take it into account, because that's really necessary as well. And then how do you build climate resilient portfolios? Well, I think there are several elements to it. First of all, you can reduce your carbon footprint of your portfolio. And you can maybe bring it in line with Paris, with the Paris Agreement. The European finance plan, the regulation has set the standards, and they say a Paris-aligned benchmark is a benchmark that, well, you exclude almost all of the fossil fuels, energy companies, utility companies, only those that are very efficient in generating electricity. And then you reduce your footprint by 50%, and then you reduce it every year by 7% until you're at net zero in 2050. And then you do that within sectors. That is how the European Union defines a Paris-aligned benchmark or Paris-aligned portfolio. Now, by doing that, of course, you're selling some stocks. You're not really solving anything. So if you want to go a step further, you need to do more. One of the things that you can do is engaging with companies. There are big collaborative engagement opportunities with, for example, Climate Action 100+. It might be interesting to take a look at that. And then secondly, looking at carbon footprint is actually looking backwards, because the carbon footprint data that we have is, if you're lucky, it's 2019 numbers. Because that's how that works. There is some lag in reporting. So you also want to have some kind of forward-looking aspect. So what we are doing at Robeco currently is we are researching how can sectors decarbonize. How much do you need to decarbonize? We look at the most carbon-intensive sectors like steel, mining, oil and gas, utilities. How much do they need to decarbonize? And what kind of technologies are necessary to go to that lower carbon economy? And then we can analyze our companies in our investment universe and say, okay, if we believe that these sectors need to decarbonize in such a way, how well are these companies prepared? And if they are not prepared, how much is it going to cost them to actually invest in those technologies? And then that gives us a much better view on which companies are really prepared and which are not. So that helps us future-proof, or as you mentioned, make our portfolios more climate resilient. And then we have also developed to test whether or not we actually, do what is necessary. We also, in our risk management department, has developed scenario analysis to test how climate resilient the portfolios are. And we're now also looking, and that's mostly transition risk, so transitioning to a lower carbon economy. The physical risks is something that we are currently looking at on how can we actually also determine how our portfolio does when it comes to physical risks. And we do that for all of our investment portfolios. So all of our investment portfolios are being tested by our risk management department, and they are being, these conversations are being held with all of the portfolio managers. So I have a fairly good confidence that all of our PMs know very well how much climate risk they have in their portfolio. It's not so difficult. There are certain sectors that are very prone to climate risk. So there are a lot of things that you can do.
Thank you, Masja. And Paul, which are the most important themes within ESG right now, and look forward, of course?
I mean, I'm in danger of repeating what Masja said. I suppose the majority of regulation coming in place at the moment in all of, in this area is understandably focused on climate and how we'll handle that going forwards as a planet. This can be focused on the energy transition away from fossil fuels towards alternative energy, but other themes are at play here. So sustainable foods is an interesting one. The food supply chain it accounts for, I think, a third of greenhouse gas emissions in one way, shape or form. It's a very significant drain on freshwater resources. So it's a slightly separate issue, but interlinked somehow with that climate issue. Sustainable mobility is the same. It's environmentally linked in one way or another. So the environment is the key focus right now. I think if you look at the newspapers, you know, the temperatures in Western Canada right now are too hot for a human to survive. So, you know, you do get constantly slapped around the face in the newspapers because very visible, very tangible climate issues are there for us to see, and hence people are starting now to, you know, those climate deniers, if you like, they've gone a little bit quiet now because it's very tricky for them to deny something that's going on. So we need to address that. Climate will likely be the most prominent going forwards, but there are some more pressing social needs, which have perhaps been highlighted by the pandemic. In fact, we've always historically found social issues were perhaps the more difficult one to talk to with our clients, which is odd because they're more about us as human beings. And the pandemic has done one positive thing, I suppose. It's highlighted some of these issues a little more. Health and safety in the workplace, getting people back to the office or the factory safely. General focus on mental health, you know, very difficult to track as the data is scarce, but something will be a very important issue across the globe going forward. Inequality, diversity, inclusion, that sort of stuff. Real issues that we have to tackle going forwards. They're starting to hit the newspapers now, but they will continue and get bigger and bigger until we address those issues. So we're scratching at the surface on some of these. Biodiversity is another key one that I think people will need to focus on going forwards. Sometimes they're linked to climate, not always, but if you get climate right, a lot of these others will sort of disappear because they go hand in hand.
Thank you. There is a question here from the audience that I would like to share. Related to cannabis. So some countries already approved or legalized the purchase of this drug. And the question here is that if they are ESG compliant or not. I mean, in terms of ESG, would you choose this sector to invest or not? And what be the pros and cons?
Yeah, oh, you want to go, Paul?
No, you go.
So we recently wrote a white paper on this topic, and we actually, in general, have a neutral view because this is also, again, I mean, it's never black and white. There's always gray areas. It's very complex, and that's why you need to do your research. And we have a neutral view on it, and we also see that indeed for medicinal purposes, it can be very good. For recreational purposes, you know, not so much. And what we are actually saying, and we make a distinction between our whole fund strategy range, so all of our strategies, and our sustainable strategies. So in a sustainable strategy, we say we don't think you should invest in companies that are active in cannabis, but in general, we have a kind of more like a neutral view on it. And our sustainable funds always go a step further than let's say our regular funds where we look at this topic. And then in general, I think the question was also who makes the rules when it comes to ESG, because it's quite subjective. I agree. And that's what Paul already mentioned, that ESG scores have a very low correlation. That's why I think the market is moving really towards more impact thinking. And there it's more objective, because things like how many women do you have in the board, or what is your accident rate? Paul already mentioned some of those metrics. Those are more impact metrics, and they are more objective. And you can really compare companies across your portfolio, and how much percentage have you invested in fossil fuels, or how much have you invested in cannabis, and those type of ways of looking at it are much more objective than just comparing, let's say, cigarette or cannabis companies within their own sector, which is the old way, I think, of doing sustainability, really best-in-class approach. And we're moving away from that to really thinking about what is good and what is less good, and what is helping sustainable development and what is hampering sustainable development.
Yes, I mean, there's nothing for me to say. That's nailed it for the cannabis question.
Okay, so we are ending our panel here. I don't know if Paul, Masja would like to do final comments.
Yeah, I mean, look, I just appreciate coming here, and hopefully you've got something out of today's conversation. Thank you very much for having us. It's a difficult and interesting topic. Everyone has a view. Sometimes it's negative, sometimes it's positive. It feels like it's getting more positive in Latin America as it is over here. And if we can help you on that journey, please just let us know. Thank you.
Yeah. Yes, thank you for having us. I really hope that we have been able to show that ESG is not only about doing good, but it's also just a reality these days. It's something that we as investors need to look at, to think about, to build up knowledge, and if we can help in any way, my team has done, I don't know, 350 meetings the last year, or this first half year, and a lot of it has been sharing knowledge with our clients. So we are very happy to do that because we think that it's important also to be an advocate for sustainable investing. And I hope we've also shown today that there's really no trade-off between sustainable investments and investment returns. And I think we should really move on from that. We've passed that station and now we're moving forward. And I hope you will all do that.
Thank you so much, Masja. Caio, heading for you.
Thank you, Mariana. Thank you, Masja. Thank you, Paul. Thanks for being here. Obrigado a todos que participaram desse painel. Aproveito para mencionar que, em parceria com a Robeco, nós distribuímos no BTG Digital o fundo BTG RBC Global Credits. Em parceria com a Enena Investment Partners, nós deveremos lançar um produto novo com a temática ESG no curto prazo. Encerro aqui a nossa Global Managers Conference com um grande agradecimento. Primeiramente, a todos os palestrantes e moderadores, o nosso grande obrigado, aos nossos parceiros globais, aos nossos clientes e investidores e também ao Banco BTG Pactual, por disponibilizar toda essa estrutura técnica que possibilitou mais essa Global Managers Conference de sucesso. Muito obrigado a todos e até o próximo ano. Tchau, tchau.